Hello, my name is Lachlan St. Clair, and welcome to the either very late October edition or very early November edition of CSP's Smart Money. The reason we're a little bit late for this edition of Smart Money is that there has been a fairly significant amount of change in the investment markets and a significant change in sentiment. And I've been sort of touching base with quite a few contacts throughout the industry just to try to sort of coalesce views down into something that's sort of fairly coherent, sort of fairly easy to understand. That's actually taken a little while to do. What I'm going to do today is outline at a fairly high level what the views of the industry are, not just domestically but also internationally. And then we've attached two articles to the bottom of this Smart Money, one from Fidelity and one from a group called Alpine Macro. They're relatively short articles, but I do think they articulate the detail a little bit better than I can do in a video. So I would certainly encourage you to have a look at those articles after the end of this video, and then obviously bring any questions into us when you come in for a chat. Okay, so what's happened in the short term? There's been a couple of fairly significant changes over the last 2 months. The first of those involves the political environment. So anyone who's had a review with us over the last 12 months or has watched the news would understand that political risks have been fairly elevated over the last 12 to 18 months or so, really driven out of two areas. Firstly, Brexit, so what happens with the UK leaving the European Union, and secondly with the China-United States trade war. The heat, however, has been taken out of both of those two issues over the last couple of months. Firstly, the UK has passed laws that mean that Boris Johnson, or the UK I should say, cannot leave the EU with a so-called hard landing, without some sort of agreement. And they have agreed, as you would all no doubt know, to go to a general election towards the end of this year. And we think, or the view of the market definitely is that the chances of them finding a deal and finding a way through this morass should be a little bit clearer in the first half of 2020. And the other one, as I mentioned before, is the US-China trade deal arrangement. Donald Trump has an election coming up in 12 months' time, and it is of vital importance for his re-election chances that the US economy and the US share market are both strong. That's really what he hangs a lot of his success on, and if they are weak running into this time next year, the November elections, he's going to be in real trouble. So it looks like, from all reports, that the United States and Trump in particular have stepped back from the hard line they were taking with China, and to a certain degree, China's also stepped back as well. Their manufacturing sector's come off quite significantly. Both these countries have paid a pretty heavy price for this battle so far. But it certainly appears that the political timeframes imposed on Trump through the United States political system has given him cause to come back, and that seems to have, or step back, and that really seems to have matched up with some of the data out of China, sort of making China fairly amenable to finding a solution to this as well. So at a political level, as I said before, both the heat has seemed to have gone out of both of these two issues, and is leading the market to be a little bit more confident moving forward. The second thing that's occurred over the last little while is that, firstly, as you would all no doubt know, reserve banks globally have been cutting interest rates. So the domestic bank here, the Reserve Bank's cut interest rates down to 0.75%. The US Federal Reserve's been cutting rates. The European Central Bank has been cutting rates and moving back towards quantitative easing. What that has done impacts the share market, I should say, in two ways. Firstly, it improves the valuation of companies. So when you value a company and you do what's called a discounted cash flow model, and you count up its future money, you need to discount that future money by a certain number. That number tends to be linked to US interest rates. So as those interest rates come down, basically the discounted cash flow model gives you a bigger number. So that's positive for the share market. And the second thing, of course, is when bond markets get really low and term deposit rates get really low, then people get pushed out of those assets and in a search for yield, and really try to sort of look into the equity markets to try to get some better interest rates than they can otherwise get. So you tend to get this technical, what we call a technical trade, where you just get this weight of money sort of pushing into the share market. Combining that with a little bit more optimism around the political environment is leading to people to be a little bit more optimistic about the prospects of the equity market in the sort of the near to medium term. The other point, I suppose, is the economy, the global economy. Certainly in Australia, we've gone through a reasonably tough period, but pretty clearly housing looks like it's found the bottom, unless there's a major retracement. One of the CEOs of one of the major banks came out last week and had called the bottom for the domestic economy here in Australia, and the Reserve Bank held rates steady the other day. So I think in Australia there's some level of optimism that the bottom may have been found, which is obviously a good thing. On a global perspective, the PMI data, so the manufacturing data out of the United States, has started to turn positive. And some of the issues in Europe, as I say, particularly around the Brexit deal may be finding a solution has led to a bit more economic optimism over there as well. European shares are still very cheap compared to United States shares, but we do think, if we get another data point or two in the right direction from an economic perspective, we could sort of start to see a few of these things come together and really create a bit of momentum for the equity market. Now, it does need to be said that this is a fairly short-term horizon in terms of the comments. I mean, we're really talking sort of 12 to 18 months. After that, obviously a lot depends on the US election. If you do see the Democrats start to pull ahead in the polls relative to the Republicans, you would expect the share market to come under pressure. It's a fairly consensus view that the Democrats would not be kind to the equity markets. So if you start to see those polls reverse, again, you need to start to rethink about your position. And obviously, the longer term, there are some really serious structural issues still facing the world. We've got $16 trillion of negative yielding bonds still in the market. Still in the market at the moment, I should say. Equities are still very expensive by any historical measure. And clearly there's quite a bit of social unrest around the world as well. You look at the headlines at the moment to see that. And I guess the final one as well is sort of becoming a bigger and bigger issue is climate change. It is going to have an impact on the global economy. I don't think you can really deny that any longer. So the really long-term fundamental view is still quite difficult, but certainly the view is that the short-term, the technicals, those issues of low US bond yields, pushing people out of bonds and fixed interest into the equity markets, combined with reduced political risk, combined with some slightly better economic news, may well mean we're going to get a rally in the equity markets over the next little while. So in terms of portfolios, as I mentioned before, there are two articles below this video that I would suggest you all have a read of before you come in for a review. And then I suppose that the question for a lot of clients at the next review is going to be, given we took that slightly more conservative position at this time last year when things weren't looking anywhere near as good, and the market is looking materially better, albeit with a fairly short-term time frame, do we start to unwind some of that trade and perhaps get a little bit of that money back into the market? So that's the question I'll leave you with to ponder. And obviously we'll talk about that in more detail when you come in for your reviews. I should also mention that we just got back from our last trip to WA. We've had the caravan over there, as I'm sure you all know. And our last trip in the October school holidays, we took 2 weeks off and we went to a place called Ningaloo Reef, which I think is, from talking to people, it's one of those places everybody's heard of, but no one's actually been there. It's actually quite a remote part of Australia to get to. If you can imagine a map of Australia, it's kind of on the far most western point of Western Australia. It's about halfway up the coast there. And it is the most pristine coral reef that I've ever seen. It is absolutely spectacular. It kind of reminds me of what the Great Barrier Reef was 30 or 40 years ago, before sort of humans got to it and sort of walked all over it and trolled over it. It is just spectacular. You can walk off the beach and do an absolute world-class snorkeling. We had the kids up there. We dived with whales. We got within maybe 5 feet of a humpback mother whale, I should say, and her calf. Dived with manta rays. Introduced the kids to wobbegongs and reef sharks and more turtles than you can poke a stick at. It was just an absolutely fantastic break. But if you do like the water and you do like snorkeling, I do suggest you put on your bucket list. It is an absolutely beautiful part of Australia and absolutely pristine condition, just a beautiful part of the world. But anyway, it's been back to work now and a few things to get on with as the investment markets change. If you have any questions, of course, please feel free to give the office a buzz. Otherwise, I look forward to talking to you all soon. Thank you very much.